All right. So you're welcome to the second video in Profitable Trader series. And in the last video, I gave you the framework, the scheme of work that we are basically going to be using, right? And that's something I've used and I've worked with to actually guide me through my personal studies, going through YouTube and other trading resources to actually help me get to where I currently am, right? And I told you that in the next video that will be coming, we'll be starting from the first decision that every trader has to make, which is the decision of what kind of trade to take, whether you should be buying or selling. So decision one, buy or sell. Now, this is just another way of saying directional bias. I know you've been hearing the word directional bias a lot. Well, directional bias simply is your bias on what direction you should be trading in, or what direction you think the market is heading in. And there are a lot of specific things. There are a lot of things that actually help us to determine where the price of an asset might be heading in within a day or within the week or within a month, right? But these concepts or these specific things that we look out for are actually very, very important things that without which it is nearly impossible to actually have a winning trade or a profitable trade, or actually even become consistently profitable. And it all boils down to the concept of trends and a market structure, right? But there are also other things that are actually also important to be able to tell what direction a market is going in. And so I'll be listing them out, the things that will be looking at, the things that are important, the things that you need to know, the topics you need to look into to be able to tell what direction price market is heading in. The first thing is trends. The concept of trends, very, very important. You need to be able to tell what the trend of a market is. The second is the second thing that we need in order to be able to tell what direction of a market is the concept of liquidity. Liquidity is another important concept that we need in order to be able to tell where our market is heading in. So we start off right away. Now there's a theory or a law of price, the law of price that you need to know. Now this law of price says that whenever price is moving, whether up or down, it's doing one of two things. It's either that it is giving fair value, or it is seeking liquidity. So price is either giving fair value or seeking liquidity. Now, what does this mean? Price is either seeking fair value or giving liquidity. Fair value, I'm going to be explaining what fair value is and what liquidity is in a couple of moments. All right, just stick with me. So, what is fair value? What does it mean when we say price is giving fair value? Now, there are two words here that make up this phrase: fair and value. Fair, to be fair, means to be equal, to give equality between two or more persons, multiple persons, to be equal between participants, opposing participants, right? Then value, when it comes to trading value, we are simply talking about price, right? Now, fair value, when price or the market gives fair value, it is simply giving an equal opportunity for a participant of the market to have to get in on price, or to get in or have an equal chance or equal advancement in a market. Now, what do I mean? Now, another word for fair value is retracement. I know you should be familiar with this word, right? This is another word for fair value: retracement. We either say price is giving fair value or price is retracing. But what is fair value? Now, we'll explain this with a practical diagram. Now, take for instance, the market is buying. This is an uptrend. Now, there are two types of trends. uptrends and downtrends. Right? If a market is buying, the market will be moving in an uptrend. An uptrend is simply a trend that is moving up, right? Uptrend. Then a downtrend is a trend that is moving down, downtrend. Market that is selling, right? Now let's take for instance now that this is an uptrend, right? We are having price creating highs and lows, higher highs and higher lows, and I will talk about market structure. We'll talk about market structure in this series, right? Now let's take for instance now this is a trend. Let's start with this. This is a trend. This is what a trend, an uptrend looks like, right? Now I will not fail, just so we don't move towards move too fast, I will not fail to talk about something called the price wave theory. This will actually help you understand better what I'll be trying to explain in the course of these videos. Now the price wave theory is a theory that tells us how price moves. Now, what does the price wave theory tell us? The price wave theory tells us that price does not move in a straight line, but it moves as a wave. So price does not move in a straight line. It moves as a wave. It means that if price is moving up or price is moving down, or an asset, the price of an asset is selling, is buying, or an asset is buying or selling, it will not move in that direction in a straight line. Price moves as a wave. Now, many of you, those of you who might have done physics in high school or secondary school, depending on what your country is, you must have been taught waves. Waves, right? Light waves, sound waves, and we saw the structure. You've seen the structure of a wave. Now this here is the structure of a wave, kind of like a zigzag pattern where you have up down up down up down up down up down, right? And every high is creates a crest, right? A peak, and then the lows create something called a trough, right? Or a valley, right? So that's a wave, and that's the same way price moves. Price does not move in a straight line. Price moves as a wave, right? And this is what we expect to see whenever we see price moving. Whenever we see price moving in a certain direction, whether price is buying or whether price is selling, it will move as a wave and not in a straight line, right? And a trend is simply price moving in a direction, the direction that price is moving in. Whenever price is moving in a certain direction, it moves in that direction in what we call a trend. So the word trend is just another word for direction. When you say the trend of this, the market is trending, we just mean the market is moving in a direction. Or when you say the trend of this market is up, we are just saying that the market is moving in the upward direction, right? So if trending for a market, if trending for a market is price moving in a direction, right? And the right price wave theory tells us that price does not move in a straight line. That when price is moving, it does not move in a straight line, but as a wave. What that means, what we can now infer from that is that when price is trending, price trends as a wave. The trends of markets exist as waves. If price is in an uptrend, what we'll be seeing is an uptrend wave. If price is in a downtrend, what we'll be seeing is a downtrend wave. That's how price moves. Price does not move in a straight line, never does, right? If price moves in a straight line, it's going to correct itself and create that wave-like structure. Price does not move in a straight line, and so it moves as a wave. This is a very important concept that you have to take note of as we move on in this series, right? And so I said, for instance, this is an uptrend, right? Now there are two parts to a trend. Every trend has two parts, right? And these parts of the trend are called, okay, let me write it out. Parts of a trend. Every trend has two parts. Every trend has two parts. The first part of a trend is the impulse move, the impulse. And then the second part of a trend is the retracement. Now, I'm going through all this because I want to explain what fair value is, right? So every trend has two parts, impulse and retracement. Now, what is the impulse part of a trend? The impulse part of a trend is simply that part of the trend that moves in the same direction as the trend. And so if a market, let's say for instance now, the market is, we've analyzed and we've seen that the market is making an uptrend. The impulse part of that trend, and I will go on to show you this practically. The impulse part of that trend is this part of the trend that is moving in the upward direction, because the trend of that market is up. Let me just write out the definition. And the impulse is the part of the trend that moves in the same direction as the trend. That is what the impulse move is. The impulse is the part of a trend. Every trend, the part of any trend that moves in the same direction as the trend, is what we refer to as the impulse, right? And then we have the retracement. The retracement is the opposite of the impulse. The retracement is the part of the trend that moves in the opposite direction of the trend. So impulse is the part of the trend that moves in the same direction as the trend, and then the retracement is the part of the trend that moves in the opposite direction of the trend, right? And there are two types of trends. We have only two types of trends. Uptrends and downtrends. Now we have something called a range or a consolidation. I don't focus on that. I will show you what it looks like, but I don't trade that. Profitable traders don't trade retracement consolidations, because consolidating markets are markets where you can lose your money easily, and so it makes more sense to only trade a market that is trending, moving in either an uptrend or a downtrend. Those are the best market conditions to make money. The worst market conditions are consolidations, right? So we wait during consolidations, we wait for the market to escape or leave that consolidating phase, then we get in on a trade, right? And so let me show you. So this is what an uptrend looks like, following the price wave theory. That tells us that price moves as a wave. If price is trending up, price is moving upward, we are going to be seeing price making both highs and lows, right? We're going to be seeing buys and sells happening. But when we check overall, to check the overall direction of this market, what direction this market is moving in overall, we will get to see that the market is going higher. It's moving higher, right? And that's what qualifies it as an uptrend. Mind you, take note that if a market is in a downtrend, that's selling, you are going to be seeing buying and selling happening at the same time too. If a market is in an uptrend, you're going to be seeing buying and selling happening at the same time too, right? That's where the understanding of how price moves comes in. Understanding that the price will never move in any direction in a straight line. No matter the direction the price is heading in, it will move as a wave, which means that we'll be having both buying and selling happening at the same time in that market. And so this is an uptrend. This is an uptrend, a depiction of what an uptrend looks like, right? And then this is a downtrend. This is a depiction of what a downtrend looks like when the market is selling, when the market is moving lower. Don't mind my diagram. So this is a downtrend, right? And you can see the wave, like the zigzag pattern, the zigzag manner in which it is moving. This is totally normal. This is how price moves. And this very structure is actually what even helps us. It benefits us as traders, because it creates a kind of understandable or predictable pattern. Predictable gives price a kind of predictable nature, adds a level of predictability to price that allows us to be able to catch trades and get entries as many times as possible, as long as that trend remains viable, right? And so I said that there are two parts of a trend: the impulse and then the retracement. Now this is an uptrend here. You can see that overall the market is moving upward, and then this is a downtrend. Even though we are having both buying and selling happening, you notice that overall the market is moving lower and lower and lower. That's how we know. That's how we spot trends, right? But there are two parts to a trend: the impulse and the retracement. Now we said the impulse is the part of the trend that moves in the same direction as the trend, right? So we are going to be going into an exercise to help you be able to spot impulse and retracements in the two types of trends, in uptrends and in downtrends. So we said the impulse is the part of the trend that moves in the same direction as the trend. Now, what is the direction of this trend? Up, right? This is an uptrend, right? And so, what parts? Because we can see parts going up and parts going down, so you can clearly tell that there are two parts to this wave, to this trend. Now, what parts of this trend are the impulse moves and what parts are the retracements? It's pretty simple. The parts that move in the same direction as the trend is the impulse move, right? So if this is an uptrend, it means that the parts of this trend that move in the upward direction are, by extension, our impulse moves. So this here is an impulse move. That part that moves higher. This here, from this low to this high, again, is another impulse move, right? From this low here, this is a low, right? The lowest point that price gets to before it starts moving up, that's a low or a swing low. From this low to this high is another impulse move, right? In this uptrend. So in an uptrend, the parts that buy are simply the impulse moves. Now in this downtrend, what parts of this trend are the impulse moves? Yet again, very simple. The part of an impulse move is the part of the trend that moves in the same direction as the trend. So the parts of this trend that move in the downward direction in a downtrend, those are our impulse moves. So sell from that high to this low is an impulse move, and then from this high to this low again right here is another impulse move, and then from this high to this low yet again is another impulse move, and then from this high to this low another impulse moves. So simply, impulse moves are part of the trend that move in the same direction as the trend. Capish? So then what are retracements? Retracements are the opposite of impulse moves. The parts of the trend that move in the opposite direction of the trend are what we refer to as retracements. And so if our trend is an uptrend, the parts of the trend that move down, that move in the opposite direction, meaning that the part of the trend that sell in an uptrend are the retracements, right? And a retracement is simply a brief movement in an opposite direction, in the opposite direction of the original trend, right? If price is moving in one direction, a brief movement in the opposite direction is what we refer to as a retracement, price retracing, right? And so as easily as we could find the impulse moves, you should easily be able to spot the retracements in this trend. You can pause the video right now for the next 5 to 10 seconds and by yourself try to spot the retracements in this market. Just pause the video right now. I'll give you 5 seconds. Pause the video and find the retracements in this uptrend and the retracement in this downtrend, following the definition of what the retracement is. And so I believe you must have done that exercise yourself, and hopefully I'm sure that you're able to spot the retracement properly. Now in this trend, I'll just go on to mark it just to fulfill all righteousness. This high to this low is a retracement because it moved in the opposite direction of the trend. This high here to this low is another retracement in this uptrend. This high to this low is another retracement in this uptrend, right? And so those are our retracements in an uptrend. So in an uptrend, the retracements are simply the parts of the trend that sell. The parts of the trend that sell when the market is moving higher, making an uptrend, are what we refer to as the retracements. And then in this downtrend, you can pause. I believe you're able to do both for the uptrend and downtrend when you pause the video. So the retracements in an uptrend are the buys, the parts that buy, that move higher. Those are the retracements because they move in the opposite direction of the trend. And so this is another retracement here. Another retracement. I'm supposed to change the color, but for time I won't do that. I won't bother with doing that. I know you're all smart and you can easily understand and infer what I am doing. All right, so this is what we mean by impulse and retracements, right? And something to quickly state. I want to state something quickly before we move forward. As traders, we trade the impulse move. We fade the retracement. We ignore the retracement, and this is one pitfall where a lot of people who try out trading. This is where they meet their first pitfall, because they are unable to make a distinction between impulse and retracements. They end up trading every move in the market. The market could be in an uptrend and they are buying and they are selling at the same time, which is wrong, which is not supposed to be. As a trader, you should understand that your best chance of making money is in trading the impulse move. Because what is an impulse? An impulse move is that move that tells us who is leading in the market, because in every market there are two participants. There are two participants in every market, buyers and sellers. And out in trading, when it comes to trading, there will only be, most majority of the time there will only be one leader, one person leading out of these two participants, and whoever is leading between the buyers and sellers is going to determine the overall direction that that price of that asset is going to go in, or the overall strength, who is going to be, it's going to determine who is stronger in that market. And remember what I said in the first video about us as traders following the leader. We are simply playing follow the leader. Our job is to analyze and see who is the leader, the buyers or the sellers, and then join the buyers in buying or join the sellers in selling, depending who is leading the market, right? And so what this means in more technical terms is that as traders, we are tasked with trading the impulse moves. Our job is to find the impulse move and in join that impulse move, right? And so as a trader, it is important for you to be able to know what parts are impulse moves and what parts are retracements in an uptrend and or in a downtrend. It's so important, so important, because your profit, your capital depends, the safety of your capital depends on your ability to tell which is the impulse move and to join that impulse move. So keep that in mind, right? And so I was trying to explain what fair value is. So fair value is simply the market's way of creating equality or creating fairness in the market environment, because in a trending market, most times only one, if there was no fairness, if there was no fair value, if there was no equality in the market, only one market participant will just keep having a field day in the market. Let's take for instance an uptrend and a market that is buying, that's in an uptrend, right? Every impulse, let's say for instance now, after every impulse move, whenever the market buys, in this move now, in this move from this low to this high, only the buyers have had an opportunity in this market. Only the buyers have had influence on price in this market. And so at this very point, there is no fair value, there's no fairness, there's no equality, because sellers have had no opportunity in this market. And the market is the market has such an environment where it likes to create equality, and that's where you see retracements happening. Whenever the market is retracing, what the market is doing is the market is just creating equity or equality between buyers and sellers. And so after every impulse move in an uptrend where only buyers have had an opportunity to be a part of price, you see the market retracing in order to give sellers an equal opportunity within that phase, during that phase of the market. And so we have a retracement that retraces for a short period of time to a certain point before a new impulse move happens, right? And this is basically how the market creates the price, the wavy nature, how the market moves as a wave, up and down, buys and sells, highs and lows. That's these the price wave theory in practical. This is how the price wave theory comes about, because the market likes to create fairness. And so after this new impulse move that has been made here, only buyers again have had an opportunity to be a part of this market. And so what does the market do? The market creates an opportunity for sellers to take a part in this market, and then the market retraces for a bit before the new impulse move starts again. So what we simply mean by when we say that price is either giving fair value or seeking liquidity, what we mean by giving fair value is that we are saying price is either retracing. If price is moving, most times either price is retracing or seeking liquidity. And if you are a fast thinker, you would know that at this point that seeking liquidity is simply referring to an impulse move, to the market making an impulse move, right? If fair value refers to retracement, seeking liquidity refers to the market making an impulse move, right? As simple as that. So price is either giving fair value, retracing, or seeking liquidity, making an impulse move. In a downtrend, this is what it will look like. In a downtrend, every sell or every impulse move has given only sellers, as only sellers at that moment participating in the market. And so the market creates fairness, equality, by giving fair value, right? Retracing, giving buyers an opportunity in that market, and then the market sells again, makes another impulse move, then gives buyers another opportunity. And with every new impulse move, there is a need for a retracement to happen, because after every impulse move there's inequality, and then a retracement is needed to create a balanced, equal nature in the market. Right? And so this is what when we say that price is either giving fair value or giving liquidity. Now, this is the second video in the series, and I'll be stopping here, because these things I've shared might seem so basic, but they are so important. Every other concept that we'll be looking at in the rest of the series is hinged upon your understanding of everything that we've talked about in this video, right? And I believe that the explanation is as simple and is concise enough to be able to grasp from watching it just once. But if need be, uh, go over it again, understand the concept again. If you have questions, ask questions in the comment section, and I will answer them. I promise to answer them. But these concepts are so important, and as we start dive deeper, you start to understand and see why they are so important. And so, as an exercise, go through multiple markets. I'm currently on gold, so let me calm down. Well, I'm gonna calm down. I'm gonna show you. Let me delete. Okay, let me just use previous price action, so I won't mess up with my current analysis. Uh, let me show you. This is the 4-hour time frame. Time frames are something we'll talk about in subsequent videos when we start getting to the point where we actually need to start noting what time frames we are using. But we can see clearly that this market is an uptrend from this low here, from this point here, where my cursor is, up to up there. You can see that the market is going higher. We're having higher prices. We're having price creating new highs, higher highs. Prices. So clearly, this market at this point is an uptrend. And another thing you should be able to see now that you've been taught it, is you should be able to see the wave-like nature, the wave-like pattern that price is making while moving in this trend. You can see price making impulse and retracement. You can see price seeking liquidity, but also giving fair value in this market. You can see it very clearly. You should be able to see it very clearly. It's happening. It happens all around price on your charts. Many of you might not have been able to make sense of it before today, but now it should start making sense to you. You should start seeing the reason why after price moves in a certain direction, it moves in the opposite direction, right? And you should be able to know now that you are supposed to fade the retracements and focus on the impulse moves. But basically, you should see that, yeah. uh what I want you to do is, this is currently gold, but on any instrument. It could be on stocks, it could be DXY, it could be Nasdaq, it could be anything. It could be it could be euros, forex pairs, euro USD, GBP USD. But any instrument, any financial instrument you take a look at, you are going to see these exact same patterns printing themselves on the chart. So what I want you to do is, on any time frame, you can use the daily time frame or the 4-hour time frame, right? What I want you to do is mark out, note a trend, find an uptrend or a downtrend, and then I want you could use your highs, or you could use your rectangle tool, like I did earlier, to mark out the impulse and the retracement in that trend. Mark them out. Do this until you are able to easily, without even needing to spend more than 5 seconds, you can easily tell, okay, this is the impulse, this is the retracement on this chart. What you want is to get so used to doing this that you become so fast at it, right? At this point, it's the goal is to get so good at spotting these things that you don't spend anything less than 2 to 3 minutes when doing your analysis, top down analysis from higher time frames to lower time frames, and you already have your setup. Less than 2 to 3 minutes, you should be able to look at the chart and know what trade you are taking next and where you are taking that trade from. And that's the major goal of every topic, every video I'll be releasing in this series. But this is where you start from. This is the foundation of it. Look through your chart, spot the trends, and then note your impulse and your retracement, and remind yourself I'm only going to be trading the impulse moves and not the retracement. And this is very important to your growth as a trader. I don't know how many minutes this video is, but I'm hoping that it's less than 15 minutes. But even if it's more than 15 minutes, I'm sure it's interesting enough that you will not mind. And so if you find this video helpful and you would like other traders like you to be able to find this video also, I want you to like, subscribe, turn on the bell notification so you know when I drop new videos within the week, and leave a comment, ask your questions and I'll answer them. So thank you for spending your time in this video. If you stayed till this, if you stayed this far in the video, I know you're going to find it very helpful. So enjoy your day, have a nice day ahead, and make sure to study.